¿Qué más?
Nada, ya ahorita no va a poder trabajar con Fernando, con Mario en el radar. Ya puse en contacto a Nicolás con los de Luz Verde y con los de Criptos. Y ya le va a pedir la información a Charbel después de ahorita la sesión. ¿No se ha metido nadie? ¿O te has dejado que pase?
No tengo idea, ¿no? Ni siquiera el speaker.
Sí, porque ya van a ser las 11. Ya son casi las 11. Oye, Fernando, una pregunta. A
Ujú.
nivel Estados Unidos, para ser un accredited investor, tienes que hacer un examen que se llama o Serie 7, o Serie 85, o Serie 65, algo así. Y para Ecuador o a nivel Latinoamérica, ¿se valida con el mismo examen o es por eso aparte?
A ver, hay diferentes formas de, de ser acreditado. Uno es por net worth, otro es por yearly income,
Sí, pero es que no cumplo ninguna de esas.
y la otra es trabajar, ser un knowledgeable employee. Entonces, trabajar, o sea, trabajar para un fondo de inversión sí creo que te acredita.
¿Sí te acredito? Porque justamente le quería proponer eso al grupo de mi familia, pero no sabía cómo se podía usar ese mecanismo o ese vehículo. Ya después, más adelante, te preguntaré bien.
Entonces, creo que me hice amigo de tu papá en LinkedIn. Puede ser.
De Don Gino.
Ajá,
Sí, sí, Canoso.
ajá.
Sí, justamente hoy día me voy a reunir con él. O sea, voy a almorzar con él. Ahí más tarde le cuento. Ahorita están, ¿cómo se llama? Bastante con el tema de energías renovables, porque genera, o sea, dentro del grupo, se llama Grupo Equilibratum. Hay como que algunas compañías y la nueva es Genera, que es la que está sacando adelante con mi hermano mayor. Entonces esa es como que la bebé y la engreída del grupo.
Hacen algo con energía solar.
Sí, ahorita está empezando en fotovoltaico y se está empezando a ampliar ay, se me va, con, no era algo ¿cómo se llama? Con un blend de gasolina, no me acuerdo cómo se llama, que justamente mi hermano se fue a hacer un internship a Dubai cuando tenía mi edad, creo que un poco mayor, y salió con ese proyecto en mente. Entonces ahí es donde nace Genera, pero primero se van por lo fotovoltaico, que es lo más fácil de ingresar. Entonces ya han cerrado algunos contratos con fábricas, con casas,
Chévere.
y ahorita, es más, justamente
Después,
están,
después me cuentas más. Oye,
sí,
Carmen, ¿qué será de David Lichtblau? ¿Sí te contestó?
Sí me contestó. Acabo de ver que no le puse el link. Dame un segundo.
Ahí te copié un
Listo.
email al Guillermo Lazo y al hijo y al otro.
Ya, ahorita,
Ya les agregué a la lista de.
ahorita vi. Oye, le tienes en. Ahí entró el David. Perfecto. Ya me puse a sufrir.
Hi, David.
Hello, hello.
How's it
Hi,
going?
David. Sorry, I didn't include the link initially. Glad you picked it up.
All good.
How are you?
I'm doing pretty well, actually.
Congratulations on the Series B.
Yeah, it's perfect that we got that done between when you asked me to do this and when it's actually happened. That was all part of my plan.
Awesome. Was
All
that
around the
B1 or
Buente
B2?
session.
What is it? BA or BB? What's?
So we did this one in two parts. We're calling it a Series B, but it actually had two tranches.
Okay. Well, so I'm going to introduce you. I can never remember how to pronounce the company.
My company, Sentio.
Yeah. Sentio?
Yeah.
Okay.
Hola a todos.
Buen día.
¿Cómo están?
Hola, buen día, ¿qué tal?
Hola, Rafa.
¿Cómo están? Buenos días.
Buen
¿Qué
día.
tal todo? Bueno, mientras van entrando, nada más le cedo la palabra a Fernando para que le dé la bienvenida a David y hagamos el switch a inglés. Y aquí lo sigo viendo.
Listo. Okay, well, welcome everyone. The team seems a little light. I don't know. I'm still waiting for a few people to join. I guess they'll be pouring in. I'd like to introduce you to David Lichtblau, ex-colleague and really good friend of mine from San Francisco. He's currently the CEO at Sentio. Before that, he was the CEO at ETF.com. And he's a tech entrepreneur with a long history and has raised several successful rounds and sold several companies as well. So it's a real pleasure to have you here, David. Please amaze us with your stories about the
Oh boy.
the life of an entrepreneur. Thanks, Dave. David, take it away.
Okay, well, hey, first of all, my apologies. This has to be in English. Mi español no es bueno. And it breaks my heart that I never got good enough in Spanish to conduct a meeting. I guess just Fernando and Carmen promised me that I could just be informal and I don't have a presentation. So I thought this would be an interactive conversation on experiences so far. And just because it's not a presentation, it'd be a lot better if you go ahead and interrupt and make it a conversation. Just kind of a quick background on me. I'm a techie, and I'm a product of Silicon Valley. So I went to school in Palo Alto, California, and started my career in the technical field. I was in product management. Started the career at Oracle. You can see by having lots of experience, that's another way to politely say I'm kind of old for Silicon Valley. So, kind of quit Oracle to start a company. This was a long time ago, right when Netscape and those companies were just getting started. And the first one was a pure tech company where we were kind of pioneering the work of what today we call big data or data warehousing or business intelligence, these kinds of concepts that were really kind of taking off as terms. So coming out of Oracle and being a technical person, this was basically enabling graphical user interfaces like pivot table graphics, drill down charts, 3D, that kind of stuff against large scale backend systems. So basically tying Windows front ends to Oracle backends, which was, we were ahead of our time. It was just before Oracle even had a Windows product. So you can kind of guess the time frame we're talking about here. And for that company, I was, co-founder, et cetera. And in terms of the fundraising around that, we were bootstrapped. So this was like doing things the old-fashioned way, actually finding clients by not paying yourself and trying to get our first folks on board and referenced and all that stuff. So we were lucky in the sense that our first venture capitalist actually found us, before we went looking. which is not normal. We were at a conference, you know, we had like a whole diagram. It's online analytical processing. We had like a multi-tier structure to the whole system. And he's like, this is exactly what I'm looking to invest in. And that really kind of opened the door to expansion. We were able to get Sequoia Capital on board after that. So these are, you know, Michael Moritz became, you know, one of the board members who later on had much more successful investments in places like Google that turned him into a rather wealthy investor. But before he became famous and all that stuff, he was on, you know, our board, you know, helping us, you know, grow our market, which was, you know, in the United States and beyond, actually, and eventually had a successful exit to a company, Oracle's biggest competitor of the day, which was Informix Software, now part of IBM. So that was kind of startup number one. And then, so I guess basically there are 3 startups kind of under my belt, and on the 4th one that I'm working on now. The second one was a company called StarMine, which was all about equity analytics, so stock market for financial professionals. We sold to Wall Street. We sold to the investment banks and the global investment banks and institutional investors. So it was an analytics company. So the themes through all this stuff is a lot of analytics was throughout. And this one was relatively light in terms of the amount of venture capital required, but very consistent growth. So we raised money from primarily what you'd think of now as kind of fintech related, financial technology related focused people and strategics, step by step, where, you know, each step along the way was growth. You know, how much, well, ARR basically are you guys delivering, you know, each quarter? And those were our metrics. That one we grew to well over 40 million in ARR, you know, well over 100 million in exit value, and a sale to Reuters, right? You probably know them as a news service, but as part of Thomson Reuters, they're one of the largest financial information providers in the world, number 2 after Bloomberg. And I became part of that organization, Thomson Reuters, for a couple of years, and kind of ran a $500 million product line there, the one that caters to portfolio managers and analysts around the world. So that was an exciting run. Really good ROI for our VCs. Really good ROI, but on each one of these has been good ROI for our VCs. And after I ended up leaving Thomson Reuters, I discovered this company and met Fernando, which was later to be named ETF.com for exchange traded funds. And we provided analytics, research, news, events, conferences for everything related to the ETF ecosystem. This also was venture backed, very much in the fintech space. So think folks like Credit Suisse as kind of the primary funders, and went through multiple rounds there and eventually had multiple exits, actually. More exits than companies, because we sold the analytics piece to the competitor to Thomson Reuters called FactSet, which is a publicly traded company in the US, a multi-billion-dollar financial information provider, and our events business to a different entity. So that was kind of the first 3, all VC backed, all growth stories, all positive investments for our investors. And today I am CEO of Sentio, which is another research platform for financial investors and also for non-financial corporates. So today we are working on natural language processing. We're basically taking all of the unstructured data that investors care about. So think about earnings call transcripts, annual reports, filings, news releases, research reports from the big brokers, all this like 50 million plus kind of financial documents, parsing all of that to understand the financial context around it and serving that up almost like, not like a Google, but like a research tool that knows how to parse and understand financial context, including sentiment, entities, relationships across the whole financial ecosystem. And we sell that to professional investors and to the folks in corporations that that do research against competitive and their own competitive intelligence. So think of companies like Pfizer, the drug manufacturer, that needs to stay on top of every single drug that gets filed from any one of their competitors. They do the same kinds of research that professional investors do and need to have the same kind of comparables and analytics that investors do. So as Fernando said, we just closed so I guess with Centio so far, I've done 2 rounds of we've had a Series A and a Series B. And the Series A I closed in 2018. We had a lead investor who is, they call it growth equity. So it's for companies that are a little bit more established and not pure seed sort of VC. And then we just closed our Series B. It was a $20 million round like a week ago. So it's kind of timely, I guess, if we're talking about fundraising. This round was led by another growth equity firm in the fintech space. It's called New York-based 10 Coves Capital. It's kind of a division of a multi-billion-dollar financial investment outfit that focuses on the kinds of companies like us, kind of high growth opportunity, mid-market, beyond the seed stage, but nowhere near the kind of unicorn stage of people that are in that kind of Series B stage of development. So it's really, really good fit for what we're looking for. So that's just kind of the quick background. From there, I don't know how best to kind of structure a Q&A, or if there are some ways that we may want to facilitate a conversation with all of us. I know it's easier to see you all if anyone wants to turn on their camera. I think we've got about 6 cameras on and about 14 of us on. But when you're halfway around the world, it's a lot more interactive when we can see each other. So if, how might I help from here in terms of thinking about, I'm happy to do this in a Q&A format, or or otherwise I'll start rambling, which could be trouble.
I suggest, if anyone has questions in between, let's do that. And if not, well, Fernando and I will sort of make a 2-way fireside chat with you, and the rest can start jumping in as we go. Do you agree, David?
That sounds great. I'm very open to format, and I think the high level topic was fundraising. That seemed to be of the most interest, but we can speak to that specifically, or we can just open it up to any other aspect of the entrepreneurial journey that would be of interest.
I think that since you've gone through several stages of both growing a company and fundraising in between and stuff, so maybe if you can give us a little bit of a super high level understanding of how those different stages of fundraising and the key learnings you've had throughout the different fundraising experiences, what has been the connecting thread of good practices, mistakes, and also the responsibilities that come once you get funded. There are several questions within that, but that might be just a starting point.
Okay, well, I imagine many of you are in the seed stage or kind of really early in your development, and so what it means to fundraise might be a question. How to go about it might be a question. One of the things, and then what was the journey after? I think Carmen was asking. So, one of the takeaways for me is that you are always fundraising. Like, I keep thinking, oh, I'm finally done. The money's in the bank. And, it turns out it's just like when you're in sales, you're always selling. So I maintain let's call it a database, whatever, a contact system of every potential investor that might touch my ecosystem. And, you know, a lot of that is developed through referrals. A lot of that is developed just through online research and looking to see who is funding the kinds of companies in my space, who are the kinds of partners that would be useful to have, both, like if I could imagine a press release with this firm, who would I want it to be with? And, you know, that sort of thing. And then just maintaining the connection to the extent possible. So like, always think, who else should I be talking to? It's just like a good sales network of referrals. You get a client, the first thing you want to do is make them happy with your service. But beyond that, who else should I be talking to? Who else do you know? You're based in whatever, New York, Panama. Can you give me anyone else I should be talking to? You like what we're doing? Let me tell you more. And then always keeping them current, right? So they feel like they're part of the system. It turns out, I mean, professional investors want to do what we do because they're in it for the money. But you guys are also in a early stage of development. And I think a lot of folks that may want to help you, like even people like me, are not even really in it for the money. Like, I don't make any money on this call. Right? You want to find your allies, right? You want to find people that enjoy your story and want to see you succeed, and can be proponents of your journey. And I think a lot of those folks end up being potential investors, right, over time. So there's the small scale investor, and you guys are probably very interested in the small scale investor right now. And then there's the larger scale stuff like this Series B that we're working on, that we just did, where there's a kind of a big difference between the angel style investor and this institutional style investor. And with the institutional, everything gets, I think this was, Carmen might have been asking this, gets a lot more serious. So like, we're just adding a new member to our board, right? And the institutional investors joining our board becomes a full part of the executive function of the company, and where you want somebody whose opinion you respect enough that you actually, hey, I want you to meet a potential head of sales. I want you to interview my head of sales. I want your advice on this candidate who's going to be potential head of sales. Because as leaders, often you don't really have other folks in your company to run these kinds of questions by, like the big strategic questions, the most important hires, the big kind of corporate decisions that need to be made. And that's where the big institutional investors can really be high value add, right? I think I may have just diverted on a tangent. Did I get to all the things? Whereas the small investors, the ones that just like your product or just like you, are good just in the same way that social media is good, right? They become advocates out there to promote what you're doing and what journey you're on. So this company I'm in now, we've got this, I was telling Fernando, we did the Series B in 2 tranches, which is not typical and not something I'd necessarily recommend, but we needed the money. So there's that. And so on the first round, it was a large group of smaller investors. And on the second round, it was one big investor, right? So, I mean, a second tranche, I should say. So our Series B came in 2 pieces. And, you know, the smaller amount of money with the larger number of investors were really useful because you, are practicing your pitch over and over again. And in my case, a lot of the people I'm pitching to we sell to investors and they are investors. So they could also be users, right, of our product. So I kind of get trying to get a kind of a synergistic effect to that. So do you know anyone in your circles? And so I've got a bunch of investors in Hong Kong now, and we don't have anyone on the ground in Hong Kong yet, or in Asia at all, right? So to now have, like, I now have investors in Hong Kong, Singapore, and Australia, which are kind of the top 3 locations to start financial technology sales for Asia. And having friends in these places, so to speak, is really, really helpful, even for small dollar amounts in investment. And then the institutional side, it's just a completely different game, right? Now you've become really, really accountable to people that are used to real metrics and that actually have votes in the overall corporate governance of how everything works, and even get kind of preferred returns, right? So you got to satisfy them first, and it really holds you accountable and keeps your game at a better level. That may have been all over the place, Carmen. I apologize. Was there some context I should go back to?
I think Luciano has a question.
Yes. Hi, David. Hello. Nice meeting you. This is. I mean, what's your advice or your experience on this? As you said, we are all in an early stage. Okay, in fact, we are in, let's say, in a seed stage. Okay, and we're trying to raise like maybe 1 million, 1.5 million. I don't know. Okay, but the thing is that we're experiencing something that we didn't know we're going to go through this problem. This problem is that actually you're trying to sell your product, to sell your company to an investor, okay, to get the funding, okay, and probably that's the easy part, or the easiest part of the process, because the next stage is, okay, what do you need? What do you want? How much money do you want? Okay, and in that stage, you come to different variables. Okay, to answer that question. One is the money you need, and probably you don't know exactly what's the amount you need. Okay. Second, how much are you willing to give up on the equity, to the dilution. Okay, and actually probably the way you settle this agreement will influence the next funding stages, but heavily. Okay, so actually we don't know, I mean, how to sell and how to how you say that, okay, how to determine the way you deal with this situation, and what to ask, the dilution, the different variables that are in place in this stage, you know.
Okay, so I think you've opened up, I think, at least two different questions that I think we need to think through, right? One of them is valuation / dilution, right? And
exactly.
One is how much,
valuation is another variable of this process. You know, the valuation, how many are you asking, dilution, the money that you are asking for is because you need it, or you think you need this amount.
Yeah. And you probably do need it, right? So I may be a little bit conservative compared to other entrepreneurs on this. So a lot of entrepreneurs are super aggressive on valuation, and they pride themselves on the valuation, and really want to, really worried about dilution. And which makes total sense, right? The more you believe in your company and your product, the less you want to be diluted. Also for control issues and that sort of thing. So I may be a little unusual in that I worry more about running out of money, right? It's a tough environment out there. Look, right now, there's tons of liquidity. There's a lot of investors, people with cash they don't know what to do with, and they're looking for companies to invest in. At the same time, that may not be true a year from now. I mean, I don't know, right? I don't know. I don't claim to know. I'm not predicting a recession or anything. Don't get me wrong. But these things do go in ups and downs. And there are times when raising money is very difficult. And the easiest way to send your valuation to zero is to run out of cash. right? So for me, so that's just one thought. Like, I don't worry that much about the valuation. The other thing, just to bear in mind from the purview of the investor, is that investors are in it for return, right? That means they need a low valuation. That's the whole point, right? They're like, they're running their models and they want to see, at least a 3x out of what they're doing in a modest case, right? And ideally a lot more than that, right? So if the valuation is lower, then the investor has a lot lower risk. And, I think a lot of entrepreneurs kind of set this up as a me versus the investor kind of thought process and negotiation. And in my mind, hey, this is somebody that's going to part with some hard-earned money from somebody else. I want them to make money. I want them to come back and say, I mean, you probably even heard me say this before we raised the question, like, all of my investors have made money. Good, decent returns, and that feel like they would now recommend me again as an entrepreneur, right? Like, I'm not a one and done thing, right? This is something where I want those investors to think, yeah, this CEO was a fiduciary to me. This is the kind of person I want back, right? Because I feel almost guilty taking people's money, right? I'm weird about this stuff, which is not normal for an entrepreneur, right? Like, okay, I'm a steward of money that you're entrusting me with. Let's make sure you're going to make some money out of this, right? And so I guess that's a long-winded way of saying, take more money. I would take more money than you think you need. Even, in the early stages, I would worry a little bit less about dilution. I mean, look, there are comparables out there. If you raise it too high a valuation, it actually makes it harder to do the next raise, right? Because you keep setting the bar so high, like, and if you ever do get stuck with a down round, it's just not a good look, right? So there are cases, again, this is kind of like, we're entrepreneurs, we're taking huge risks enough as it is, but to de-risk it in a little bit for your investors and for your own ability to raise later, I think is a worthwhile trade-off, even though it doesn't maximize the payoff in, when each of you build your next unicorn. But most companies don't end up being unicorns, right? Right. So you also, I want to make sure I plan for success in a successful business kind of way. Like, hey, yeah, we got this up to whatever your objectives are, 10 million in revenue, 100 million in revenue. And, at that point, everybody's going to be, your shares are going to be worth a lot more money than they are now. And the dilution isn't going to be as big a deal. Now, I know a lot of people wouldn't agree with that. So I don't pretend to have the answers on this. But hey, at the seed stage, valuations are pretty arbitrary. It's not a multiple of earnings. It's probably not even a multiple of revenue. Right? So, some of these companies that come out of, Y Combinator and the kind of the famous, incubation hubs of Silicon Valley are valued really high. And if you're an investor in something like that and you don't have that kind of stamp of approval, so to speak, it's really risky to be an investor in those companies. I mean, you to be an angel in companies that are valued at like $8 million on no revenue at all. Right?
Absolutely.
Right? You got to be, maybe it depends a little bit on what you're trying to do with your company, but and I think, and Fernando reminds me, the mindset of Silicon Valley compared to, say, Quito, maybe think of it differently. Like, so Silicon Valley, it's like, there are a bunch of investors, if you're not going to be the next Uber, we're not interested. Right? If you can't show me a path to $1 billion outcome, we'd rather make 100 bets and lose 99 of them and get, $1 billion outcome that's going to drive all my returns. that's one thing, in which case, you know, the early stage valuation really doesn't matter, and it's just growth, 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 no matter what. Spend is all the money you get as fast as you can get it to demonstrate growth. But that may not be the reasonable approach to do in outside of that kind of Silicon Valley context, right? Where you may be building a business that you would like to thrive even if you only grew 50% a year, 30% a year, right? And so you got to keep your valuation, you know, reasonable and attainable, and so that all your stakeholders along the way are feeling good about the process as it unfolds. In my, again, these are just personal opinions. So
what you say? What is the standard for you? The standard of dilution for a seed or seed round, or let's say a pre-series A, something like that in between. I don't know.
Yeah, I mean, look, I think a typical round, seed A, B, you're looking at somewhere between, depending on this, there's no rules, right? Like 15 to 20% dilution in each round, right? And that of course compounds. So you need to get the value up more than 20% each time.
Yeah, and that's my point, David. If you're saying that the dilution is, let's say, 15%, okay, and you're looking for a ticket of, let's say, 1.5 million, okay, what you're saying is that your valuation is 10 million pre-money.
So if you are doing, well, let's just say, well, if you were doing a 20% dilution with 1.5, you would be at 7.5 post.
But when you're doing that number, you're immediately giving your valuation. See, so for me, it's a process that you have to how you say, support that number. You know, it's very tricky for me to say, okay, if I want to dilute 15-20%, and I'm asking for 1 million, then my company is valued in 5, 6, 7 million. And how do you support that number? Because
look, at that stage, depending on if you have any real metrics or not, you know, a lot of it is more art than science, right? So you're presenting a vision on how, let's say, you know, and again, I think these Silicon Valley valuations may not be as realistic for a Latin American based company that isn't like in the heart of this craziness, right? Like that we have. Like, you think you guys are generally more sane than we are. So, you know, if you raise $1 million on 5, you say, okay, 5 million, what is, you know, where do you expect this company, where do you think this company can be in 4 or 5 years, that 5 million today actually makes sense? And you can see you know, at that point, because it's so risky, a really high IRR for that investor, right? So that investor needs to see kind of a path to call, I don't know what the right number is, I'll make something up, you know, 40% IRR, right? 50% IRR. So that, you know, presumably you're going to need to double and then double again in kind of that valuation within a finite amount of time frame that the investor can believe in. You know what I mean? Right? So that that initial valuation is a bit magical, because clearly you don't have any earnings. And to justify it, you need to have a story. It's really a narrative.
Yeah, I
right,
mean,
on where that needs to go.
I was doing some research, and I found out that I don't remember exactly the numbers, but the Series A for Rappi, okay, was around 9 million or something like that, okay, and 3 or 4 months later of that, they went to a Series B, and they got 50 million. So in 4 months, they went from 5 or 9 to 50. And you say, this is crazy. I mean,
Yeah.
How do you come to that numbers, you know?
Well, so just as a practical matter, I think there are two kinds of rounds, right? I'm not sure if this is a fair statement or not. One where it's not really a round because there's no lead investor. You're driving it. You're basically setting the terms in a convertible note or some other form, and you're pitching a bunch of small investors that probably won't do deep diligence to invest at kind of a fixed rate, right? And you say, hey, we're raising 1 on 5. It's a seed round. You know, there's going to be no new, board governance or anything like that. You're in, you're out. You know, you've got your investment materials, and it's relatively straightforward. It's just a lot of hustle, right? And then you've got a more competitive round where you have more than one VC who's trying to become a lead investor, right? And they're actually, it's not you shoring up, individual small checks one at a time. It's you trying to have an actual institutional investor come in who is competing with another institutional investor, right? Now you're in a better position. But I think a lot of you probably aren't quite there yet, right? And you might want, so think about, like, is this like an, the company's kind of setting the terms and hoping to get a lot of people signed up, or an outside party is setting the terms. So I have no idea on Rappi how it went, but I imagine there was somebody at some institutional firm got really excited and chased them down, right? They really liked the potential, the traction, the story, the vision, the team, and it got competitive. And so
I
did the company
think
really
we saw
change its
that.
value that much? I doubt
I don't
it, right?
remember, but I think it was SoftBank, the Series B, something like that.
Oh,
they
well,
have,
so
they have
SoftBank-
big money,
Yeah,
something like that.
like today it's not even valuation, right? They're just, to them, they're in that kind of unicorn or bust kind of model, right? Which may or may not be appropriate for many companies. So they just have huge checks. They don't know how to deploy them they spend billions on like WeWork and all this crazy stuff.
Yeah.
So for them, it's just like, I'm making a bet on a space and a team. It's not even about the financial numbers as the company is right now.
Absolutely.
Right.
Yeah, SoftBank is behind the lead I think it's the lead investor in the Series B of Kushki. So they're spending big money.
Kushki is
if you can get SoftBank,
Ecuadorian-based startup.
Yeah. We got a $87 million Series B, the highest in Latin America
on
for
600
Series B.
million valuation.
Yeah.
David, I have
SoftBank.
just to close out on that point that you said about the two different types of rounds in our portfolio, we've seen that happen with Nuevo Cargo, where they had a pre-series A valued at 16 million that they did through a safe, and I think it was already a little bit somewhat competitive. A few funds came in on that round, and then less than a year later, they closed their Series A at a $70 million valuation, and that's because everybody was tripping over themselves to try to get in. Finally led by QED investors. So yeah, that's sort of what Deepak Chugani, the CEO, told us. You have to, if you want to get there, you have to sort of be in that mode where, everybody wants to come invest with you, right? You have that story and that growth path and that market, all that.
I'm sure you guys have read, how a lot of investors are followers, right? The hardest part is to get a leader, a lead investor. That's the trickiest part. So some of it is a confidence game, right? People only want to invest in things that other people are investing in. People want to invest in what somebody else has done the deep work on, and they trust their diligence, so they're gonna follow that investor. So like whenever you're talking to prospects, right, you need to know, am I talking to a follower or a leader, right? And if the round is going to be like an early seed round, that's kind of like the company is kind of basically setting the terms, you need to really make it sound like, this thing is basically wrapped up. do you want in or not? Right? We're closing the round. These are the terms. I've got this much subscribed. You want to have like this momentum story on it, because part of the challenge is that I'm sure you've heard, at least in English, the expression is time kills deals. Time kills deals. Things that just take too long gives everyone there's just no momentum around it, and they change their mind. There's no urgency to get out and sign your documents, right? There has to be a forcing function, and that forcing function is like you set up a calendar. This is the process. This is when it's going to go. We're going to close on whatever, July 31st. That's the plan, right? And this is when you're going to get materials. This is you got to manage almost like a conductor of an orchestra, right? You need to manage all these people you're trying to rally, none of whom are in a hurry, all of whom want to wait for somebody else to validate the decision before they do it, right? Into a time frame to align all these investors to happen at once. So there's a calendar game to it to really make that orchestration, which is why I had to do the B in 2 rounds, because I had a B1 where, okay, this is going to close in March. This was March of this year. And we're on track. These are the terms. Here's the term sheet. We basically wrote the term sheet. And, with in cooperation with one of our inside investors. And while working this outside VC firm, I'm like, look, I got this thing closing. I can't wait for you anymore. If you're serious, get your diligence done. And here's our data room. Let's hear all the materials you're going to need. I'm happy to work with you, but I'm moving. I don't have time for this, right? And you want to lead, great. We'll give you an exclusive, but for a very short amount of time. And to get those going. So I went to this crazy process of doing a B1 and a B2 at the same time, which is not recommended. But the point is, how do you instill, how do you get the rhythm of the whole thing to go, right? Because any one investor they're just never in a hurry. There's no hurry to it. I can wait and see how your company is doing later. Terms are going to be worse later, right? Let me know if you get that big client you're talking about. Give me a call later, right? And so you got to kind of have to manage, those expectations, and figure out how to orchestrate the story. Hopefully, you've got some clients that are about to close, right? Hopefully, of a product milestone that's about to ship, right? And you don't pre-sell too much of it. Instead, just like any narrative, you want to build momentum, right? So you're talking to these investors, you're telling them when the round's going to be. A month later, you're telling them the round is still going to be here, but guess what? We just landed Santander Bank. I thought you'd want to know. Okay, 2 weeks later, the round is still going to be here, but guess what? We just released version 2.1 of the software, and it is amazing. You should see what people are saying about it, right? So you're kind of leading into this funnel of closing, right? You're trying to orchestrate a whole progression of human instinct where the herd has no motive until they start moving together. I don't know if that makes any sense, but.
It does. And stepping on that, I would like to ask you whether you have any other tactics more than this rhythm when you actually do need the money. As you mentioned, it happened to you right now in Series B1, and it happens very early on also. And how do you don't let investors smell the desperation? And if you have any tactics on that, and building up the momentum and not letting them smell the need.
I think everybody knows that every startup is out of money, right? So the need is known, right? We can't hide that. Look, here's my runway. I'm pretty upfront. They're going to do the diligence. They're going to know the balance sheet. Okay. The confidence part is knowing that the clients and investors are coming in, right? I can't fake the confidence with my cash flow statement, right? There's just no way around it. So I need to have the story. I need to have the clients that are coming in, I need to have those voices of momentum. I need to say, hey, this other, famous, I can't name this VC, but we're getting a term sheet. We're so committed to this that, the founder is going to put in another $1 million. I need to orchestrate that there is a calendar, that we've got a ton of energy, that there are a lot of people looking at it, that they're giving positive feedback, and this is what they're saying. And, some of it may be, hey, yeah, they wish they'd see better gross margins, but here's how we're going to, you got to also know your objections to it. But I mean, I think the big picture of this momentum strategy is to know what your calendar target is. And then kind of back up from there. And because these things take a while, right? At least my experience, maybe I'm slow. I might be slower than when I hear about Rappi or these guys that could do it in a couple months. I don't know how the hell they do it that fast, because it takes me longer. A whole process can easily be 6 months from the time you're deciding you're going to do the round to the actual cash in the bank, right? Because you got a few months of warm up. You're telling them when it's going to happen, right? And now then you get serious about whatever 3 months before the check date, really serious. You've got a whole list of prospects that you've all talked to, and now you say, okay, valuation's getting settled. Here's where we're coming out. Here's our time frame, and there's always some story about how things are coming better. You get your term sheet. You start talking up the term sheet to everybody else. I'm going to need to get a feel for how interested you are, because I'm getting a lot of interest, and I got to figure out where to devote my time. Right. And then even once you sign the term sheet, you got to go through a month of diligence, month plus, sometimes 2 months before you actually close the money. Right. So it's just kind of, again, that's for an institutional investor. For the non-institutional investor, that's different. Right. Then you might have to tranche it up a little bit. Maybe you make, just like any sales, if you're doing it on convertible notes, maybe you tell them that the valuation's going up in a month, right? Or the cap, whatever. You say, hey, I got permission from my board. We can issue a safe note right now at X cap, but only for this month, because next month we have too much traction. The cap, it's going up. You need something to get some urgency and some calendar into a process for these folks. And this is assuming you've got a good story and a good business idea, of course. I'm just talking about the mechanics of herding the cats, right?
David, how you doing? This is Andres from Pardux. Thank you for your time this morning. I have a question to kind of flip around the what to do, because obviously this whole program has been very focused on the what to do's and how to prepare and how to build a pitch and how to build a network and how to build a portfolio of prospects. And maybe what I'd like to know is, based on your own experience, what are the don'ts? What are the hard no-nos that don't do this? But more on the theoretical side, more on, I guess, on your experience that you can share as during my fundraising process, I did this that just didn't work out, and why, so that we learn a little bit of those experiences that can allow us to prevent making similar mistakes.
I think probably it's specific to fundraising, because I've got a lot of other mistakes I've made, but in the I think you're muted on that.
I would say specific to fundraising, mainly because when it comes down to building a winner model or a winner pitch, is assuming those things are in place. Is what are the things when you're facing these possible investors? What are the things that you have said, man, I wish I would have done it differently, to help us kind of shift gears on what to do versus what not to do?
I think probably the biggest challenges I've had that turned into the thoughts I just gave you is not coordinating to a time frame. everybody wants to have regular updates. So first of all, there are lots of looky-loos. So you can waste a ton, somebody who will just ask you tons of questions, want to get all this information, and they're just not going to pull a trigger. So the biggest challenge is that just it's so time consuming, right? And you've got so many things that you need to be doing, right? So how do you weed out, like, I guess when you're desperate to raise money, it's easy to waste time with people that are just not going to fund you, that I don't know how to, they just ask too many questions. So I guess part of it is qualifying, trying to take
a proper filtration
of the relationship a little bit. I mean, I don't know, have you guys ever just, I mean, part of this is a sales job, right? I mean, it's sales. You're selling shares. You're a salesman, right? And if you have ever been the victim, so to speak, of a really good salesperson in anything you do, whether it's buying a car or a house or just anything of relevance, you know the difference between how a really good salesperson works with you and how somebody that drives no urgency at all and has no structure and they're just nice, and how they work with you, right? And so you need to be like that one that kind of has a little bit more command and authority, and not just the desperate entrepreneur that it's easy to fall into. Like, you'll just talk to anyone. It can take a ton of time, and they don't have a process themselves. So it's, I guess, what is your process for making an investment decision? Have you invested in other companies like mine in the past at this kind of stage? How did that, like, actually being really like structuring of these conversations so they're not just like tourists looking around, right? That there are a lot of, even professional VCs, you know, they send out associates that are basically like, yeah, you know, go talk to, you know, 50 companies, and just, they're half the time they're not, it's not serious. They're just looking for information on the markets. They can go back and look smart to their partner. And it's like, no, we don't need to talk to you. Like, if this is serious, I'll give you the rundown. If I want to talk to you, tell me what you invest in. I'm not going to give you an update every quarter on how we're doing, so that, you know, maybe later we have enough traction for you. You know, we got to have some authority in the relationship, if that makes sense. Like,
yes,
we're doing something special here at this company.
Got it.
And
thank you.
we're looking for people that buy into the vision. What do you think of the vision? And, you know, how can you help us make this vision even better? Like, you got to get them engaged. Just like like even if somebody who's selling you a house knows how to get you to picture living in it.
Right.
Right. So you can start seeing it, like, they get your imagination. They get, like, somebody selling you a car knows how to appeal to your ego. Like, oh, you know, you look really good in that car. Whatever it is, right? They know how to like pull you in, and to like we're talking about a partnership here. You're not just writing a check and walking away. We're like trying to build a business together. Is this, anyway? So to me, I guess a lot of it's like the same kinds of tips you might give a salesperson, because in the end, you are a salesperson.
Right. Okay. Thank you, sir. Appreciate it.
All right.
Beyond fundraising a little bit, once you know, in the day-to-day, let me think what I'm trying to ask here, but well, one of the questions is, obviously, Christian from crypto said, you know, don't start fundraising when you really need it, right? Obviously, it talks about, it's easier for that momentum story if you actually have some real momentum, and it does take a long time. I don't know, any horror stories from of mistiming the fundraising or
Yeah,
fundraising
well,
that
look,
took
I
too
mean,
long?
if it like, I mean, the flip side of this, I'm trying to talk like from a position of strength, and sometimes you don't really have a position of strength, right? And so you just have to, you're kind of acting like you do, and you got to create the environment that people believe that you do, because there are other people that are willing to back it. The problem comes in when there really aren't other people willing to back it, and you're about running out of money, right? And or which means you're running out of time, right? That's where I think a lot of people get tripped up. And I mean, this it's like a bank too. Nobody wants to lend money to somebody who's desperate to borrow, right? So Silicon Valley now, they're also doing a lot of venture debt, right? Where it's not equity. You're actually just borrowing money from a venture lender. And I learned this the hard way too. I was like, okay, I'm going to go. The time to borrow the money is right after you just raise the money, when you need it the least. So I'm about to go and extend our venture debt line. Well, it's a multi-million-dollar venture debt line, because these bankers see that you got a Series B and they're like, great, can we lend you money now? I'm like, okay. It's annoying, because I would have wished you were behind me when I really needed it. But that's just not how they work. They're to de-risk, right? I mean, like, would you lend money to somebody who is out of a job and they've been out of a job for a year and now they want to go buy a house? It's like, doesn't make sense. Of course, that's where they need the money, because they ran out of money, they have no income. So you got to present yourself as in the strongest possible way, which is always earliest. If you land a big client, that's like a great time. You got a big name client that you could announce and put on your website and talk about to investors in the pitch. That's a great time. It doesn't, even if you don't need the money. Hey, you're showing traction. That's when people get excited. You got a big distribution deal with somebody, a big partnership, anything. People kind of jump on the good news because you can project the story. So yeah, waiting too late until you're in the corner. Because I guess the other kind of thing is to diversify your investor base. So when times are difficult, who is going to step up and give you more money? Right? If you have a bunch of individual investors, that's a tough ask. If you've got an institutional investor and they have a reserve for follow-ons, that might be as large as your initial check, that's a totally different game. And, we kind of almost need to draw on this because, a year ago, well, as we all know, COVID crushed us. And I sell to the financial markets, and the financial markets were down 30+% in a couple months, in like March of 20. So it's like that. I'm like, no one's going to, I can't raise any money right now. I got this Series B done last month. I would have much preferred to do it 9 months ago, and I was not in a position of strength, if that makes sense. But the good news is we were able to weather that because we had institutional backers to begin with that didn't want to see their investment go to zero. They're willing to put in more money to get you through. So that's the kind of the big advantage of an institutional investor at a reasonable valuation, right? If they overpay for it, it's not as interesting. Like, so we never had to take a down round, right? Because the valuations were always reasonable, right? And so you can see your preferred prices always going up, and it's just a better look, right? It's a better story. And I could go and explain to people, yeah, COVID was, we thought the floor was going to come out from under us, but thankfully we actually grew in 2020. And here's all the momentum despite COVID, and here are all our new clients, and that fed enough momentum to go ahead and get us to this next level.
I have one more question, just switching gears, because one of the things that we see in a market like Ecuador, where there's very few, if any, institutional investors, or angels that understand equity, a lot of the opportunities for fundraising, a lot of the interest comes from strategic investors. But they carry their own, every investor has somewhat of a conflict of interest with the company. But strategic investors come with their own set of conflicts of interest. In your experience, can you talk to that of when strategics can be good for a company and when they can sort of come in the way?
So I suppose I would need to understand kind of the motive of the strategic investor. If we're talking about tech, and these are like big, tech companies that are investing, that might be a little bit different than, if it's a big oil company and you're doing, whatever. I think it's
usually a traditional company that's not,
that's
they're looking at it as innovation.
Innovate, yeah.
Like they need an innovation side of them. So, I mean, some of the good news there is that they might be less of a demand on you in a lot of ways. They might be less valuation sensitive because it's strategic. They might be a great logo to have as an endorsement. And you could treat them like they're a customer in that sense. So you can speak to how this great company has found you so interesting. I think there's a lot of pluses to that. To me, the minus is in where the long-term exit might come from. So if in some ways I think it kind of can close off, or I've always been nervous about it closing off the opportunity to sell the company to anybody that might be in conflict with that investor, right? So if you're in, I don't know, in my case, I'm in financial tech. If I took a big investment from JP Morgan, what's that going to do? Like, what if Bank of America wanted to buy me? How would that work? So I don't want that kind of door to be closed. So what some people do, like in a highly competitive market like that, might be to try to get more than one of them. So like if you're in oil, is it possible to get more than one oil company to like co-invest? Because you like, depending on what your service really is, I think it really depends on what your service is and how you feel that you fit into the ecosystem and how that strategic investor fits into the same ecosystem can really jeopardize it. But I just want to think 2 steps ahead. Where do my next, is this going to conflict with a future investor or a future acquirer? Right? Most investors add less value than they think they do. So they will, yeah, they're giving you money, but they're going to talk, oh, we'll introduce you to all these partners and it'll be great. You're going to get all this business because of us. I don't know. I haven't seen that as much as people claim. So if it's a company that may want to buy you later themselves, that might be good, right? But those are the kind of like what are the, it's like a little bit of a chess game. How does the ecosystem fit together with these strategics? Like, so in the financial tech space, I know at least one company that took investment from 6 global banks at once. It was like UBS, Goldman Sachs, like a bunch all at once. And that seemed like a really smart move. So now they weren't locked out of any one of them. And, none of them had a controlling interest. And it was a big endorsement of how important it was to the whole banking ecosystem, right? And that opened doors for them. I think in other cases, you got to be careful, because do I really want to sign a non-disclosure agreement with this company that is potentially my competitor, or my competitor sits on the board of it? That's a challenge. And those investors, I don't know, they seem potentially less savvy than the pure investors that are just in it for the money. But I think of myself as a pure investor, so I'm better aligned with it. So I don't know, there might be some personal preference.
I'm gonna have
I
to
don't
jump.
know.
I don't know if there's other people. I'll let you, Carmen,
Yeah.
take it from here. Thanks, David. It was
Yeah,
great
I don't
seeing
know
you again.
if anyone else has questions for David or not, and if it doesn't, if that isn't the case, then we can start closing off the session.
All right, well, a pleasure to meet you all.
Great,
Good luck with your
David.
ventures.
I think it was
And
a
I'd love to
super
hear more about
valuable
you.
session.
Thank you very much, David, for your answers.
Thank you very much, Dave. Appreciate it, sir.
Thank you, David.
Thank you.
Yeah, David.
Thank you, David.
Bye, everyone.
Bye-bye.
Bye.